The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the live beginners trading course here. Of course, today is Monday the 7th of April and we have a very exciting lesson coming up. So with this particular webinar, the construct, we will be discussing, of course, the forces of supply and demand, and really all asset classes really follow a level of compliance to the overall rating factors of the underlying investment of those market forces that make both buyers and sellers trade within a market in terms of creating demand or excess supply to actually formulate price discovery. So if we do, obviously we have a disclaimer to consult. There is risk inherent when trading the financial markets, so do be aware of the risks involved. So before we go through obviously the webinar, we do have total interactivity here. So with the live webinar, feel free to ask questions throughout. Of course, you can locate your chat box there on the right hand side of the screen. And the live webinar is being recorded and will be placed into your members area once the webinar has concluded. So if you just give us a 1 hour grace period, of course, you'll have that fully revisable in your members login area. And we will be hosting, of course, an extended Q&A session at the end of each live webinar just to go over some of the key issues in context. You can ask questions, obviously, throughout the webinar, but if you prefer to hold your questions to the end, that's absolutely fine as well. Just to consult, obviously, the timetable, just to give us an inflection point. Obviously, we are just approaching the first lesson here with week 2 of the Become a Pro course, so a very interesting I suppose analysis that we went through over the first 4 lessons. We are now approaching obviously the second week with lesson number 5, and obviously the main construct we'll be discussing this week's really the market forces of supply and demand, with today going on from sector analysis, capital and trade flows, and economic data. So now we're starting to get more of an economic picture of how financial markets operate, as opposed to looking simply at price action or some very basic analysis in terms of the construct of markets, different sentiment analysis, whether you want to become a fundamental trader or sentimental or technical trader. We need to understand, of course, that it is not a trivial pursuit in terms of approaching these financial markets. We do need to understand the context in which we are trading if we are to develop that professional attitude. That context is, of course, more of an economical basis in terms of whether you're trading off, for example, economic data. You know, what does that economic data mean in terms of the environment that you're trading in? How can you best educate yourself to relate to, understand how price action or price movement is more likely to move? And these underlying contexts of your trading environment is, of course, going to supplement and develop your own professional attitude towards trading. So in terms of the discussion today, of course, we're going to provide an in-depth analysis of underlying market forces of supply and demand. So here, let us consult our learning objectives for today. We're going to develop the concepts of demand and supply, discuss the factors that lead to shifts in the demand and supply curves, understand how supply and demand determines price and quantity, of course, explain how prices and output are determined, and we're going to understand how markets allocate resources. Okay, so if you're more familiar just on a common aspect of supply and demand, really the question is economic scarcity. You know, it really overrules markets. To give but an example, we can choose commodities like sugar or coffee, where they're grown potentially in warm climates, and that's not relative to obviously climates here in the UK and Ireland. Of course, we can't grow crops like corn, sugarcane, or coffee. You know that we have a level of scarcity there in those commodities, and we actually need to outsource the development of importing such commodities. That leads to price discovery, and that's really the focus of this lesson, to understand the total complexity of the supply and demand function within each market that we trade. So first of all, what we're going to discuss is the circular flow of economic activity. So I want to bring this down just into one domestic economy, where we view the circular flow of economic activity, showing the connections between firms and households in terms of input and output markets. Okay, so first of all, we have each domestic economy creating its own level of gross domestic product that is supplemented both by households, obviously generating a strong level of employment through those firms. They are obviously receiving your standard wage, or in whatever profession you're doing, you're earning some capital, and then you're filtering that back into the economic sector through consumerism and through mortgages, through different credit that you may use through the financial system as well. And that creates a different supply and demand function for each different type of service or commodity you're choosing to abide by within the local economy. So we have a circular flow of economic activity that is ongoing in each economy, and it follows through input markets, through creating a demand onto the firm. The firm creates such a level of supply, whether that's firms that choose to sell produce, or retail firms, or firms that maybe financial banks that provide services to you, of course. They translate then into output markets. And obviously we create that demand. We have a demand for deposit accounts, or we have a demand for food, of course, across the nation. We have a demand for cars and other luxury items as well. So it's a circular flow of economic activity ongoing, and the financial markets are no different. They are now more interconnected than ever, and there is a total secular global complexity to all of these financial assets that we trade. So how do we define output? Well, output, or product, the amount of product that is created. These markets are the markets in which goods and services are exchanged. Okay, so as economic agents, all of us are looking to define this output. Excuse me. To define this output when we transact with either a bank or a financial service, or a grocer, or any of these type of goods or services, creating an exchange between two parties. Input markets are input markets are the markets in which resources, that's labor, capital, and land, they're used to produce products and are exchanged. Again, so we're seeing a level of output and input circulating in the economy here, creating that level of business. And then payments flow in the opposite direction, as the physical flow of resources, goods, and services are counterclockwise. So it's totally cyclical, and this combines together to create such market forces that we don't necessarily think about. Often when we think about a financial market like a forex market, or the gold market, or the oil market, we think of such strong market forces like potential conflict in the Middle East. It's not always the case. If we really boil it down to look on a microeconomic level, we can understand the same principles floating in and around our local microeconomy, such as the price of apples, or the price of your local retail stores, of whatever shoes you're buying. Of course, it's all flowing through a level of economic activity. So in terms of these market forces that we'll define throughout the lesson, of course, we have what we define as existing underlying currents of supply and demand. So a market is any institutional structure or mechanism that brings together both buyers and sellers of particular goods and services. And markets exist in many forms, and they determine the price and quantity of a good or service transacted. Okay, so it's not necessarily just one party, of course, that sets the price for a particular product. If that was the case, what we refer to in that case is a monopoly, or a monopolistic market structure. That's not the case. Actually, in defining any product or service, all of these companies try and relate to the market forces. Even companies like Apple, when they're looking to sell their new model of iPhone 8 or whatever new model they're creating, They don't go to the market and simply choose a price at $1,000. They'll sample the market forces, they'll sample and do different marketing and subjectively choose how to place their product within an underlying current of those market forces of supply and demand. So in definition then, demand first, the various amounts of a product that consumers are willing and able to purchase at various prices during some specific period. We demonstrate demand schedule and demand curve. So we'll go through that in much detail. It's totally indicative for absolutely every commodity that we trade, for every product or services that flows through the circular flow of economic activity, and for global markets like Forex markets as well. Supply then we can define as the various amounts of a product that producers are willing to and able to supply at various prices during some specific period. We demonstrate by the supply schedule and supply curve. So again, an invaried function of supply and demand. So let's discuss then in a lot of detail here the law of demand. Okay, the demand we define really as the inverse relationship between the price and the quantity demanded of a good or service during some period of time. What are these laws based on? Well, first we have the income effect. Okay, and we define this at a lower price, consumers can buy more of a product without giving up other goods. A decline in price increases the purchasing power of money or real income. So 2 points there with the income effect. The first being, well, at a lower price, it's perhaps more appealing to us, given we have a level of reflection, or as economic agents, we have a level of what we call fair value, to ascertain, or to give towards a product or service. If that becomes cheaper and is obviously more affordable to us, well, that's going to create a different level of demand. So of course, the income effect is varied in one view, and of course it dictates with the level of circular flow of income in the economic sector, and our activity towards that. So from one participant or one trader within an environment who potentially has a much larger salary than one another, then of course you'll be more willing to pay a much greater amount for such goods. The second point, of course, a decline in prices increases the purchasing power of money, is a very real factor. And of course, we can simply use inflation to describe how differences in the purchasing power of our real capital can affect our trading decisions. So we don't want to see inflation rising at 5, 6, 7%, because effectively we're earning the same amount of money. As consumers, of course, we want to spend that money in the economy and create that level of production in the economy. However, if we see the prices of or the value of our income actually be eroded by inflation, well, of course, we are actually inevitably seeing declining purchasing power. So income effect is very real. Substitution effect, again, at a lower price, consumers have the incentive to substitute the cheaper goods for similar goods that are now relatively more expensive. Okay, so to give you a layman's terms example, perhaps through times of economic hardship, instead of purchasing Diet Coke for a beverage, we will simply buy one of the more substitutive products there, perhaps a Tesco Cola, or a sort of substitute cola from a much cheaper store. Of course, that actually translates in the financial markets as well. We know that oil is a good example. It has different grades to the oil, and obviously when there's more demand for higher grades because there's more boom, and we're experiencing a very strong economic cycle, then there's going to be a substitutive effect for those higher grade products. And diminishing marginal utility as well follows the same rule on demand. States that successive units of a given product yield less and less extra satisfaction. Therefore, consumers will only buy more of a good if its price is reduced. So let's say we start to create a product and we create more and more and more of that product, but we're not meeting demand. We're just creating more of the product because potentially the yield has been quite huge. Let us relate to perhaps the commodity wheat, which can happen sometimes. Nowadays we do spray obviously our wheat with certain pesticides to increase the yield, and if we get very strong weather that we have a very, very high yield, obviously that will push the price down. And the markets will have to fluctuate in terms of pricing that in. If we continue to create and produce a lot more wheat than expectations can meet, obviously there has to be a level of equilibrium. If equilibrium is not met, obviously we will start to see diminishing return for the price of such a commodity. Okay, so all of these laws of demand are constant across the financial sector, as well as your daily life as well. So let's have a look at the demand curve here, just to name an example. We have price per unit on the left-hand side scale, and obviously quantity demanded. So we have an inverse relationship between this. Market demand is derived by horizontally summing individual demand curves, of course, and market demand is derived by adding all the quantities demanded in a demand schedule which corresponds to their prices. So effectively what we'll see is how market forces try and dictate price with quantity. So this is the main factor, and again, this is what we like to focus on as traders. Why? Well, because we like to trade the price. We need to know, of course, the supply and demand function. Particularly now we're discussing demand, so whether an increase or decrease in demand, how that affects the price. So we use that standard, the one standard of price, to measure demand, or vice versa. It's not always the case. There are many factors that may change or cause a drift or a shift in demand, which we'll discuss. But for now, let us focus on price. So what we can do is obviously see with relativity here, if there's one unit traded, of course, if there's 80 units to be traded, well, this is the price per unit, and you can see the difference as we go up through the scales. You're going to see a level of appreciation to the amount one trader or one participant may want to order if you're talking about a commodity or a service. If there's obviously an increase in demand for that service, we're going to see a reflective price per unit change. So here we have only 10 quantity demands. The price per unit is, of course, 5 per unit. So that deliberates around 50 there for us in terms of the overall value or market value of such a quantity demanded. Whereas if there's 80 quantity demanded, of course, there's a much higher demand. Perhaps a consortium of groups, came to what we call contribute to economies of scale, and of course that brings the price down per unit. We effectively see the same instrument traded, but effectively the overall market value is 80 for the total quantity. And again, because it is in such an inverse relationship, we can follow and dictate prices as such by moving along the curve, or of course by plotting a series as such. So what we have here is, of course, the graph depicting our first demand curve. Now there's no shift in this curve. We're simply going to move down the curve. Again, as we see more quantity being demanded, we can see the price actually shifting again. So here in our first example, let's just look at the difference between these two examples explained. We have a quantity of 10 demanded. Well, we're paying such a high price because it's quite a low order. We're actually only getting quite a high price, €5 per unit there, which is not great in terms of competition. Again, competition is the key here. And again, when we look to follow economies of scale, we're actually looking to create an order perhaps of 80. Then we can see how drastic the changes in terms of pricing per unit and what that means in terms of profit and outlook. So what we're trying to do is include all of these market participants that may come in to the market that will add a total value or a total quantity of demand for each particular asset that you're looking to trade. And then market forces will come into play in terms of the demand function, not only for the sell side demand, obviously, or supply for that, but the actual product demand across nations to consult for an equilibrium price or a level of price discovery for each asset. So we've discussed price. Now the price is the main determinant for us as traders, of course, but we can add much more complexity to understanding markets as such. And this is going to help you when you're trading any market that you understand that can really move in terms of the supply and demand function. It's not just the price that moves, of course, but if you understand the different context between what causes that movement of price, then you're going to have a better idea to get involved in the overall momentum story of the trade. So what do we define here in terms of changes in demand? Well, caused by changes in one or other of the non-price determinants of demand. So there are other non-price determinants of demand. Demand is represented as a shift of the demand curve either to the right or left. And demand represents a change in the quantity demand at every price, so it cannot be related to a change in price. Okay, so what could we potentially discuss in terms of those non-price determinants of demand? Well, we have tastes or market preferences. So you can obviously understand when you see potential shifts in terms of market preferences or fads that may enter the market. That's not simply a change in price or quantity. It's something underlying in terms of taste from country to country or preference for that good that can change the actual demand of that product. Perhaps if we talk about certain foods or certain products like that. Obviously from country to country, people enjoy different flavors, and obviously there's much more demand for those goods in separate areas. The true numbers of buyers in the markets, again, so not just discussing one buyer in terms of one buyer or two buyers that create large orders, but the total value of buyers for a particular asset class. Capital trade in the economic environment. Okay, so how much disposable income do we have for other products? That's going to create an ambiguous level of demand for certain products, of course, and we have a definition between the economic circular flow of income and what that means for that capital trade. One being normal or superior goods. So demand varies with labor and income. Again, so the amount of labor in an economy, or subjectively the amount of income made across a certain number of samples, will of course lead to a higher percentage of purchasing on normal or superior goods. So to give you a very easy example, when we are in times of economic boom and employment is very high or unemployment is very low and wage growth is consistent, we all as a nation have much more disposable income to spend on perhaps luxury goods, so they're creating more demand for luxury goods. However, if we understand inferior goods, again, demand is actually inversely related with that income, because we are effectively to change that cycle. Obviously, if we're in a recessionary period and we are looking towards those luxury goods, well, we don't maybe prefer those at the moment because perhaps we can't afford them, and we will search for those substitutes or inferior goods to meet our needs, and obviously there's a level of scarcity there for those needs. Prices of related assets as well, of course. When two products come to market, or potentially two commodities, we can use the two benchmarks, of course. Let's say, for example, the two benchmarks, the WTI crude oil market and the Brent contract, which is more of a European UK asset. Obviously, they're very, very strongly correlated given they're both trading oil, but they have slightly different grades of oil, and there is a spread between them, usually around $3 to $4. Now that spread can change drastically. It has been at $7, $8 before. Why may that be? Well, various different factors, but the point being, of course, prices of related assets will change your perception of demand. So of course, in certain circumstances, there's going to be more demand for that preferred asset, even though we have a correlation there between a very similar product. And expectations, of course, on future price forecast, or expectations that perhaps an asset is going to be higher valued in the future, that may create more demand or a shift in demand for that product or asset. And seasonality, again, is a very simple one. We often see changes in demand due to seasonality. If we think about oil or natural gas or any of these products that do see a change in demand due to driving season, perhaps, where there's a large demand for petroleum-based products. Of course, seasonality has a very strong factor to play that is not necessarily price related. So many different factors, and what that actually causes is a very direct and visible change in demand. Now, we define changes in demand by really viewing the charts here. We have two very fine definitions. The inverse relationship between the price of the quantity demanded of a good or service during some period of time is expressed as either an expansion of demand or a contraction of demand. Okay, and here we see the two charts respectively in front. So an expansion of demand is very similarly a large increase in demand for a product. What we see effectively is the demand curve D1 shifting from D2. Expressively, what that means is, well, if there's more demand for that good or service or financial asset, well, there's more quantity demanded. So we see a shift in quantity demanded. That's going to relate to more generally a shift in price or a more fluctuating move across the curve for that expansion of demand. Again, a contraction of demand is simply the opposite. We see less demand for a certain good, therefore demand pulls back for that good or service, and then we're going to see a reflected change in price and quantity demanded in the market and different price objectives for such a market. So how may this relate to our own trading, just in terms of explaining a more common financial asset? So it's quite easy to subjectively discuss commodity markets because they relate so heavily on the simple function of supply and demand. You know, what affects the price of oil, what affects the price of cotton, what affects the price of cocoa for making chocolate. Very, very basic instinctual answers there, but more focused on you know, actually trading on a platform. Most of our trades will of course be in the forex markets. You know, it's not something we often think about simply because there's an unquantifiable amount of factors that change price when defining forex demand. But of course it comes into play. We are now currently seeing a very large increase in demand for US dollars. As traders, we focus on the end result, and that's the price movement. Again, but we also just discussed that there are many different factors of non-price determinants of demand. So, I mean, what price determinants are perhaps at work here with the forex? Why is there such an increase in US dollars at the moment? Well, perhaps related assets are much more attractive. Perhaps US assets are much more attractive, that are increasing what we discuss as capital trade flows just there into US dollar investments. I can give you one example. The US Treasury, the 10-year bond, is now for the first time in many years producing or offering a very attractive interest rate of just under 3%. So that is a very attractive investment for bond traders. What we're now seeing is a large amount of capital flow move into US denominated assets, and that's increasing a level of appreciation for the currency as well. And of course, that's what we're seeing. That's effectively what we're seeing. So the government is selling more and more US dollar denominated bonds. A lot of capital is coming into that asset, creating dollar demand. All of those nations who want to purchase those bonds, of course, will change their foreign exchange of their domestic currency account into dollars to purchase that asset, creating a large dollar demand. And effectively, it's no different in terms of looking at our previous example. We see a shift in demand, an expansion of demand to the upside from D1 to T2. Now, as traders, we don't necessarily think of that as, well, I see that the forex market here, the dollar is experiencing increasing demand. No, all we try and assume is, well, the price is moving. More specifically, if you're technical analysis, the price is moving to the upside, but that's simply not the case. Of course, there is underlying factors why these prices are moving. Again, much based on the movement of supply and demand. And effectively what we see, guys, is the same result. So here is our shift in demand from D1 to D2, the expansion of demand. What we see again is a reprice of the market. So as the market moves up, it actually increases in price again, and this is the effective price increase in and around our 96.59 level to our 98.38 level again. So effective, and then as we see a continued move to the upside again, it's a very similar factor. We've seen a price increase, and again what we would do there is simply show another shift in demand to D3 as this market continues. So again, we can structure our fundamental knowledge of potential asset classes related to the US dollar simply to look for a fundamental reason to perhaps why the dollar is moving. If we are cemented in our confidence of such a decision, then of course we can trade due to fundamental analysis. And again, we know that that's going to cause price appreciation. And again, that's simply the job of the technical analysis as well, to speculate on future price movement. So again, all of these assets do relate to a very strong function of supply and demand. And that's what we're trying to do, to focus on why these assets move so that we can deliberate future trades.